All right. Good morning. Good morning, everybody. And real quick before we get started. Now, look, I'm not in the business of running advertisements or commercials or whatever, but I used to have a Seeking Alpha subscription. I have a lot of subscriptions to a lot of places, and the cost of this one just really got to the point where it wasn't worth it because I had so many subscriptions. But right now, they're running Seeking Alpha for the whole year for like $39. I mean, that is pretty awesome. So I just wanted to let everybody know I'm not getting anything out of it. You know what I mean? Like, I'm not affiliated with Seeking Alpha. Uh, you do you, but for $39, that's for the whole year. I don't think you could beat that. Thought I'd throw that out there. All right. So we made it through, and surprisingly enough, at the end of the day yesterday, we were still in the box. We were still in the range that we've been in for a long time, right? Weeks, a month. And we have started to break down a little bit at this point, but the third choice is the one that prevailed. And at some point, you have to kind of anticipate that that's what you're going to get the more something gets hyped up, right? Like when a market gets surprised, that's where we get these gigantic moves. But the more people hype something up, the less likely that you're going to get anything at all, because there's just going to be too many people on each side. And that creates like a liquidity sandwich, right? If the market breaks to the upside, it runs into a pool of liquidity, and the same thing if it tries to break down. So it ends up just being really violent and then closing out near the same area as where we started. The main thing yesterday was the remain higher for longer, that they're going to keep going, and that we have not yet reached their target goal, which he did say they don't know what that target goal is themselves. So they certainly can't tell us. Somewhere above 5%. So that sent the market down. But then near the end of everything, he also said, I think we're near that target. And that popped the market right back up again. So I wouldn't be surprised if we see those Fed speakers come out and start to clarify. There was a lot of posts on Finance Juice yesterday afternoon as Powell was talking that were 100% contradictory, right? One post would come through that would say one thing, and then moments later, another post would come in saying 100% the opposite thing. So anticipate over the next 7 to 10 days that a lot of these Fed speakers are going to come out with a consistent message and try to clean up Powell's mess. He was slightly hawkish. I mean, it was a little hawkish, but it wasn't as bad as, some analysts had predicted that it would be a lot worse. So, and the reason we had that threat of an upside is because he kind of showed a lack of interest in how high the market had already rebounded up off of those lows. And if he was going to continue to have that lack of interest, he could have let it just continue to run upward. So I'm interested in what we're going to get over the weekend, and if we're going to get what they call the full Ginsburg, and that would be one of the Fed speakers going through all of the major networks in a single day, like on a Sunday. They just make the rounds, hit every major network in a day. The full Ginsburg. We are not the only ones running rate decisions. Europe just hit, and on the overnight, there was also another one that hit a 50. We're going to continue to see other nations in the world try to out hike the Fed or out hawk the Fed. Musk is still selling Tesla shares, so it's down again another I think it was 2.5% this morning. And this fits in kind of with what I was talking to somebody about yesterday. They said, hey, what's a good trade to go long? You think it's time to buy calls in Tesla? Not just because it's fallen down. No, right? We don't want to reflexively try to go the other direction just because the market has fallen a long ways. We need a better reason for that if you're going to buy a call or a put. Now, if you're doing spreads, right, doing something a little more complex that you don't need the movement, then yeah, sure, hey, no problem. Put on a credit spread or something. But if you're going to buy a call or buy a put, you kind of need that thing to go somewhere. You can't have this vague idea that you think it's going to stop doing something. You need an idea that it's actually going to do something. So Bank of England, 50 basis points. They're now up to 3.5. Someone notified me yesterday that there was an impersonator in the Twitter Discord. Be very careful if somebody direct messages you. And it's not just this post this time. In general, if you have had a conversation with someone, say it's Bob, and then later on, Bob reaches out to you and it's not in that same message that you were already carrying on with Bob, it's a brand new message. That's not Bob. That's somebody impersonating him. Yesterday, somebody reached out and sent me a picture showing that there was another me running out there. And I said, well, just check the hashtag number because it's pretty easy to spot them when they don't have the exact number on the back end. Well, this one actually did have the number on the back end. It looked exactly like mine. It looked exactly like my account. Now, this isn't just me. This happens to moderators in Discords all over the place. It's a thing that's going on out there. One thing that stood out on the person who was pretending to be me is they had a brand new account. So the account had only been open for like a month. So what you can do is you can right click on a user and get their user ID. It's a string of numbers. There's not even one letter in it. It's all numbers. And then you can try to report them to the Discord report team. I did that last night and it was a process, man. I had to hunt for it. You have to fill out the form just exactly right or they keep kicking it back to you. It's not easy, which I gave them a piece of my mind on that. But, it's scammers. Just delete them, block them. Don't give these people information. Protect yourself, please, from scammers. And I will never reach out to you just randomly like, hey, what's up? I don't do that. If you reach out to me, I will respond to you. I'll try to help you. But I don't just reach out to somebody randomly out of the blue and try to proposition you. It's not my thing. All right. So please be careful. All right. We got ECB announcement, then the housing, jobless claims, which honestly enough could have a little fire today. And then we've got these additional auctions, but nothing past 11:30, which is awesome because that leaves our afternoon free for a 0-day should we get one. Oh, back to finance juice real quick. Catch the left side here. Make sure we don't have anybody out there chipping their teeth. And other than the press conference, which is going to start in like a few minutes, I believe, let's see, no, that's an hour from now. One of my finance juice actually uses East Coast time, and then the other finance juice that I use uses my time. And so I always have to double check these. No Fed speakers on the docket yet, but it won't surprise me if we start to see them by the weekend. All right, so by the time we get into the afternoon, we should be free and clear. We won't necessarily have much to worry about on that end. But please watch the clock today at 11 and 11:30. These front end auctions have a lot more weight than you would think, mainly because they never get any attention anywhere. I talk about them all the time, every day. If we have an auction, I bring it up and talk about it, but they're not really publicized anywhere. And it just seems like a normal day, to anybody else. I can't tell you how many times I've seen the market turn on a dime and we get violence and volume and volatility come in right on the clock, right at 11 or 11:30 or 1 o'clock when one of these auctions come through. They have stopped me out of trades. They've turned my 0 day from winners into losers. They will impact your afternoon if you're not prepared for it. So heads up. By 11:45, if there's going to be any response to these things, we should already start to see it. And by noon, you're free and clear to start your 0 day. Your afternoon 0 day. Volume is within the normal range. This is accumulated volume that started at midnight. We're looking at a benchmark somewhere between 100 and 200. I know that might seem kind of wide, but we're looking for anything that stands out. Really, really low volume, showing that everybody's standing on the sidelines waiting for something, or really, really high volume, showing that something happened out there and people are drastically hedging their positions. Remember, in the futures, most of the trading that's going on is not actually people directionally trading it. It's hedging. So when we see an overly extensive amount of volume in the morning, it would show that a lot of hedging happened. And if we understand that there was an event, great. But if there was nothing going on that we knew about and we seen it really high or really low, we would want to start looking around trying to figure out, what was that? What are they responding to? So we don't need it because it's in line. So we just turn it off, get it out of the way. More than 80% of the time, an indicator is noise. It doesn't give you actionable intelligence most of the time. And I think that's where a lot of people make a mistake. They believe if they have an indicator on, like an RSI or a MACD or stochastics, that whenever they look at it, it has something to tell them, like looking at the clock. You can look at the clock at any time. It's going to give you what you're looking for. It's going to give you an answer. But indicators most of the time are not giving you an answer to anything. It's just noise. All right, so you can see where the sell-off started last night. Surprisingly enough, it was a little before the kill zone. The kill zone is a time frame between 2 and 4 in the morning. Historically speaking, the biggest moves that happen in the market happen in the kill zone. Ponder on that at some point when you have some free time. Bigger than the open, bigger than power hour, bigger than any other time frame that we have in our entire 24-hour trading period. The biggest moves in the market historically happen between 2 and 4 a.m. Now, I was taught to call it the kill zone. I've seen other names for it, but it's from 2 to 4. If you don't trade in the US, say you're somewhere else in the world and you're awake during that time frame, that might be a really good time to trade. I'm sleeping, so I'm not getting up for it. All right. As you can see, we're still in the same spot we were. So through the first and the second quarter, and even into the third quarter, we've been selling off. Now we're in the latest part of the year, less than 2 weeks to go, and we're still just right where we were. 3994. And while the market might have given a little bit back in the overnight hours, this is not extreme yet. We haven't even begun to really break down and see that capitulation low, and we certainly don't have a ripping, roaring move to the upside. One of the things about new traders that really they struggle with is the idea that you can't trade swing trades just because you happen to have some free capital. You actually need a market that's doing something, that's going somewhere. And as you can see, we haven't gone anywhere. Since June, we've been holding this range. And granted, it's a really big range that I have highlighted here. But we need a resolution of this. At the end of the week on 11/7, when we were sitting at 4,000, we've done nothing since then. It's been over a month. We're still in the same spot. We have wicked out across the top. And as I talked about the other day, I've really not seen a lot of markets that make this wick out, come back in, and then run it back to the upside again. Now, since the week isn't over yet, this weekly candle could come back out and begin the breakout to the upside. But I don't believe that. I don't see that in the cards. Not unless some data comes out between the econ we have today and tomorrow that might send us up back out of this box. Instead, what we generally see, and by the way, there's a gap that needs filled down here, but we see where a market does this reversal, that is the bull trap, gets everybody sucked into it. They think we're going long, they buy in, and of course, to get out of an order that you bought in, you have to sell. It adds to the selling of all the other trades that are selling, pushing to the downside, and we squeeze those bulls in that trap, force them to puke up their positions, and we get an exaggerated sharp move to the downside. Tomorrow is OPEX. Every third Friday of the month is OPEX. So you can always just bring up the calendar, look at Friday, 1, 2, 3, OPEX. Depending on the broker that you use, they often highlight it different ways. This is actually a quarterly expiry, but then there's also, your monthly and your weekly, and then, SPX, your dailies. But it is the third Friday of the month. One of the things about OPEX that makes it so difficult is it brings in a lot of volume. And for any of your tools that are using volume, well, they become so muddied that you can't get a clear signal out of them. There's a lot of volume that comes in because those institutions are going to be rolling their positions or adjusting them. Most of them aren't going to exit what they have. They're just going to adjust them. And that just brings in a whole lot of volume, but without any real bias behind it. It's not like they're loading up to go long or short. They're just maintaining something that they've already been holding. But that volume, it messes with all of our volume indicators, right? So it kind of distorts the picture a little bit. Speaking of volume, VIX yesterday frustrated a whole lot of people, and it was really just a lack of clarity on what the volume or what the VIX was supposed to actually be giving us. You know, Tier 1 Alpha in their publication mentioned more than once this week that volatility was going to get crushed after FOMC. That wasn't a maybe. It wasn't a kind of sorta. It was going to get crushed. No matter if the market sold off or exploded higher, we were going to get a volatility crush. And so a lot of people were frustrated yesterday when the market sold off hard and the VIX really just kind of shrugged and didn't do anything. The point of being out here on the daily chart is to get the point across that we still have not done anything. And until we lose one of the market structures, one of the pillars, we're going to continue like this. Apple or Microsoft or both need to either begin the climb back up out of the hole or really just drop down into it. All right, so we have our sell-off. Let's bring the other one in. We don't have an MDP because we did hit the daily pivot. We're still above the weekly, but just barely. Once we cross below the weekly, we're going to be, quote, bearish in the market, right? That's it's kind of our bias. We have an ADR of 1.78. Half of that ADR is 4,000. We're already underneath that. The full ADR is 39.66. And that's within our range. We are inside day breakout, so we are already outside of yesterday's range. Now we're getting a little bit of a Busby, trying to decide if we're going to keep outside of that range or not. Just remember, when we get to a pivot point like yesterday's high or yesterday's low, we want to go beyond that level because that's where liquidity is at. So this could be a little bit of a bear trap. Suck everybody in. They try to go short and we squeeze them and rip to the upside. We don't know yet, right? Especially with it hovering there, waiting for econ this morning. So just be careful with the bias yet, right? We don't have enough information to say, well, we need to bear up and go short. Sure, we're down nearly 1%, but we're right at structure. All right, 10-day, 30-minute volume profile. The structure that I was talking about is this volume down here at the 39.64 area. This is not a handrail to lean on. It's not a floor to stand on. We don't expect it to be support, but we would expect the market to respond at this level. First touch bounce, maybe a little bit of a stabilization. It doesn't owe us anything, right? So it's not supposed to hold up the market and stop it from going down permanently, but it would be like falling out of a tree and hitting every branch on the way down. It's going to slow you down a little bit. This would likely slow the descent, but not stop it. And there's two levels, 39.60 and then 39.30. 39.30 is a cog line, and it's also a critical level that we've revisited many, many times this year. It's got a lot of memory to it. And that is the lows of this range that we're focused on. When we're at the low of the range, we expect to go to the high. When we're at the high of the range, we expect to go to the low. The point of control is over our head. So even if we did begin running back up, 40.78 would be where the point of control is at. And it's very likely going to be a significant amount of resistance to get through it. 5-day, 5-minute volume profile is what we call marking out the 5 by 5. You can see we're very close to the volume point of control. This is a VPOC is a virgin point of control because it's untouched. I don't make this stuff up, right? This thing was named long before I come around. VPOC is also not support. We wouldn't expect it to hold the market up if we actually get there. We are expecting a response out of the market. A first touch play, like a bounce, a reversion play where we get there and we go back in the other direction, rallying into a resistance before rolling over. It is an area where we expect price to react. Okay, so we want to know where that level is. We have a VPOC now over our head from yesterday at 40.75. So if we do make that move to the upside, we've got a very large day to deal with, and then we have 40.75, a VPOC. If we get below 39.78, there is a VPOC, but it's so very far away that it's unlikely we would interact with it today. Ten-day, 30-minute volume profile and 5x5 volume profile just provide their own input, right, from that time period only. There's not a lot of intraday today volume on a volume profile that I would use. When I tend to look at that volume, I look at the DOM that I'm using in my trading because the DOM has the volume profile in it. And I use Jigsaw, so my DOM has the volume profile in it, and then it also has my VWAP inside of it. It's VWAP off volume inside of that DOM as well. So, you know, I tend to use a little more advanced volume profile on today's price. With this, we're looking at the yearly chart, asking how far away from the 10 we are. We're underneath the 10, just barely. We're sitting in the center of the basketball court. So from this spot, we could make an exaggerated move to the upside or the downside, and we are not overbought. We are not oversold. We're sitting right in the middle. When you're in the middle, you've got the room to run in either direction a considerable distance. What that means for the ES, a considerable distance, would be 3% away from the 10, either to the upside or the downside. If this was Apple, Tesla, something else, it would have its own average distance from 10 that we would need to contend with. This is the 10-day, which is pretty responsive. You step out to the 10-week, and we can see that we are still above the 10-week, just barely. About a 1%. We haven't adjusted yet. So this white line is the 10-week. You can see where price is. We can see where the 10-week is. We're underneath it. We're still on track to get our 5,200 cross up in the financials. That's almost destined to cross over at this point. We did get our crossover in the industrials. We're on track to get them in staples. We did get it in healthcare. XLU is a long ways from the crossover again, but it is turning back around after crossing down in October. Energy continues to maintain above it. They're almost running side by side in a parallel form. Same thing with consumer discretionary, which owns a lot of Tesla in there, right? It's not, it's a basket of stocks, and Tesla makes up a large part of that basket. But the smaller Tesla gets, the less weight it has in there too. So there is that. Technology also kind of running this parallel form, has not yet given us a crossover. And materials are on the way of getting that crossover. Still don't have it yet. If you were to kind of step back and look at it in the bigger picture, a lot of these are not range bound like the rest of the market is, right? Like utilities continues to expand. Healthcare continues to expand, although they are running into the next area of resistance, 144, 143.5 in healthcare. Staples, there's a lot of really good names in staples as a trade right now, more of a longer term, but food and food companies are able to pass through those food costs. General Mills, Campbell's Soup, right? Kind of go down the list. They're looking really good. So things that are down this morning, gold and gold miners and the China names. With gold and gold miners down, one of the things that we want to do is take a look at the pairs. When US dollar Japan goes down, gold generally goes up. And with that move yesterday in US dollar Japan running up back towards that 138 area, put pressure on gold and kind of brought it down a little bit. The VIX continues to be a worthless dud. It's more about closing prices at the end of the day on this right now than anything else. Yesterday's violence didn't get people what they were looking for. There was a little bit upset about it. And for the dollar, we did come up off of that that structural level. When it comes to the dollar, depending on what you're looking at, you can see that structure. UUP was sitting on the 200-day support, 200-day moving average, broke through that to a weekly level, bounced off that support and rallied up. So keep your eye on US dollar Japan and US dollar China. They're going to really reflect what's going on with the dollar. And as I've been saying for, I don't know, 6 weeks now, the dollar is not as impactful as it was, but it's always going to be one of these two. So when the VIX started doing good and the dollar didn't, we were just swap over and watching the VIX. Now it's kind of flipping back the other direction. The VIX isn't really responding all that much, and we're seeing more assistance out of the dollar. All right, move.gif. This is the bond volatility. It updates once a day, so it's not very useful in the intraday. It's more for looking at what happened yesterday, kind of figuring out where we are today, and then what we should expect going forward. But as you can see, the bonds had a lot of volatility. they had run up really nice off those lows. So it was not much of a surprise that they were going to give a little bit back yesterday. They were the very definition of overbought. OVX is volatility for oil. You can see that that's been coming off significantly as well. It is not a surprise, right? Like Tier 1 Alpha had said, prepare for that volatility crush. There was just this gigantic unknown in the market, which was causing all of the trading activity. Once that unknown become known, people were Xing out of their hedges. Makes perfect sense. All right, VIX 9-day. Pretty tight compression compared to its peers. I mean, that really just sums it all up right there. This is the front end, as close as you can get on the VIX front end, unless you were to just go in and look at the VIX futures with a lower expiration date than this. VIX 3-month, which is 2 more months beyond a regular VIX. If we're going to see some form of capitulation move to the downside, we would begin to expect this moving back up, breaking above 26 and pushing into those 30s. So with the S&P down this morning 1%, this isn't giving us anything, right? We're down nearly 1% in the S&P. This should be elevated. So the VIX isn't going to be very helpful or useful to you today. Now that could change, right? I mean, it can all just suddenly come to life. All it takes is some trading activity in there to get that going, but we don't have it. So sure, you want to continue to, monitor what's going on in there, but I wouldn't put my eyeball on it all day long expecting it to provide some sort of insider clarity, because we're not going to get it. UUP, on the other hand, one of the dollar symbols that we use, is up close really close to that $28 mark, and we're up more than a quarter this morning. More liquid and more easily monitored in the pre-market is the DXY. Got a pretty little bull flag going on. We did make it through that structural resistance at 104 and a dime. 104.5 is going to be a level that we really need to contend with. But the support did hold. And now we're either going to form this massive, gigantic head and shoulders, or we're going to negate that whole thing and begin to rally back up. So the DXY below, say, 109.5 is still just forming a head and shoulders. It would need to get beyond that before we start to say the head and shoulders is not going to unfold, right? So there's your shoulder, head. We're looking for that next shoulder. Neckline break. We're looking at the dollar back down, 95, 92. That's a long, long ways away. We're on a weekly chart. So, we're talking like August of next year for this thing to unfold and give us those kind of follow through. In the meantime, what we would be expecting, however, is dollar coming back up to form the other shoulder. Looking at the VIX curve, we are in contango the way that we're supposed to be. This is the shape that it's supposed to have. Low on the left, high on the right. The left end is where we're at, January 23, scaling all the way out to August of 2023, going higher the farther out in time we go. That is the very definition of contango. It's what it should look like. We had a little bit of a divergence yesterday between finance and mega cap, basically the fangs, the monsters of tech. We don't really want to call this NY Fang a tech symbol, right? Because it's not. It's more of a mega market cap symbol. Either way, finance was breaking down a lot more than technology was, and this was providing a tech versus finance situation when it's supposed to be tech and finance. These are our risk on sectors. They're supposed to be a unit or a group. We can be bullish with one or the other, but we can really get bullish or bearish if they're working together. So when they're not together, we get a lot of chop, a lot of diversity in the markets that keep flipping over and going back in other directions. We want them working as a pair. So when they're not, when they're divergent, expect chop, or expect that a lot of your other tools aren't going to work. Right? We kept just melting higher and higher yesterday until the FOMC, right? For through a large part of the morning, we just kept testing and pressing new highs, a grind higher. And none of the tools were really useful yesterday. We had a significant divergence in the advancing versus the declining issues. We had a very high number of advancing issues, but the money flow was significantly negative. So there was a real divergence there in the money flow. The takeaway is, even if we can't use this to trade, right? Even if this kind of information isn't actionable, it can at least warn you not to trust your regular tools and or not to try to step in front of this train that's coming at us. We already knew that the whole situation was because of FOMC, so it wasn't that big of a deal. But if you had saw this and there was no FOMC that day, then it would be a huge warning, right? Like, don't trust the tools that you're looking at. Something's wrong. They're not working correctly. Sometimes that's the best you can get, right? And I mean, that's fine. That's better than nothing. The K-Web being down very likely has a lot to do, or excuse me, yeah, being down very likely has something to do with China um, getting overrun. Their healthcare systems are just getting hit hard. They're trying to reduce their COVID zero policy a little bit at a time. And the ramifications of that are massive quality of citizens getting sick and hitting their healthcare. And of course, with KWEB down, emerging markets are down. Since emerging markets has a whole lot of China in it, semiconductors are down, not a surprise. Along with just about everything else, because the S&P is down about 1%. So we would expect most of the market to be down as well. On the positive side, the VIX and the dollar are up. Not much of a surprise. And nothing else is showing they're all zeros. In the chip names, every single name on my list is down more than 0.5%. Energy's not down as much as we would have expected. Anything less than 0.5% really doesn't hit the radar. So it needs to be down at least that much, including Occidental, which now that Buffett is in there, it's getting more attention than it probably deserves. We talk about portfolio diversity, and some of that comes from getting in names that don't have a high beta. Commodities tends to do its own thing, irrespective of what's going on in the S&P, but it is highly connected and correlated with energy. Those are also down this morning. More of them are flat than down, or maybe it's about a 50-50. The EV market, Li Auto up more than 1.5, XPEV, Lucid, all of them up more than 0.5%. Some of your China names like the NIO and is down more than 0.5. GM and Ford both down more than 1%, and of course Tesla 2.5% this morning. And no help out of the pot stocks this morning. We might be finally starting to see that breakdown in the financials that we've been looking for. We did get our gap breakdown in XLF. Got a quarterly level right at $34. If we get below that, there is some structure at 33.5, 33.4. It's a monthly level. And then below that, we kind of get into an air pocket with no help until we get to $31. This is a really nice topping pattern. And now we're going to be looking for that rollover. We've been sitting inside of this quarterly level. So we're going to be looking for that breakdown in the financials. We do have a 20-period weekly moving average down there. We're at 34.24 this morning, and that 20 period is at 34.13. So if we break that weekly, we've got a nice drop down to the 200 weekly, which is at $32. Now looking at the monthly, we're all clustered up with a bunch of moving averages here. And there's nothing. All right, apples below 4, 10, and 20 on the monthly, excuse me. We're still going to be watching for 138. We're down to 141 this morning. We need to get outside of this box. A break below 140.25 should be a straight shot to 136.5. It's underneath all of its moving averages. There's on the daily, there's nothing below us. And since we're sitting at 141.30, we're still inside day, but just barely. On the weekly, Microsoft came up and tagged that 50 MA, took a rejection off of that. Here in the pre-market, we're down to 254.5, but that still leaves us at a pretty strong position. $252 for an inside day breakout to get all the way through the wicks from the violence of Tuesday. If you're looking only for yesterday, I think we're there. We're pretty close. Now, what you're going to want to be looking for is a big picture change, right? We're not just talking about the wicking outside of the range today. We want to see an absolute shift in market structure. We need market breadth to really start to give up. We want to see an increased volume flow, which is going to be hard because of the OPEX. The volume's already going to be there because of all that rotation that's coming in. That's going to make it a little bit tricky. But Thinkorswim has these tools called Sizzle. So you could come into all products, come down to today's options statistics, and you can see your Sizzle over here. Well, that didn't help. Let's try it again. All right, so the Sizzle index that is the combination. Get out of the way. The Sizzle index is the combination of the call Sizzle and the put Sizzle. Sizzle is 5-day average. So over the last 5 days, it looks at all the call volume and it asks, are we above the 5-day average or below it? 1.0 would be that we're right on the average. Anything less than 1, we're below the average, and anything above 1 is above the average. Since 1 is basically 0, because when we're at 1.0, we are at the average. A 2 would mean that we're 1, and a 3 would be 2, right? Hopefully that makes sense. But that's just one side. That would be just the calls. Then you get the puts, and you subtract the 2 from each other, or you add them together and divide by 2. I think that's how they do it. And you get your Sizzle index. If you're looking for an elevated volume level, you would want to see the sizzle up significantly, 2, 3, 4, 5, but that's just options. Then you have volatility. It's the 5-day volatility. And what we're looking for is volatility elevated, right? And 1.0 would be that we're at the 5-day average. Above 1.0 would be that we're above the average, and below is we're less than the average. Stock sizzle is shares of stock, right? It's not calls and puts. It's actually the shares themselves. If you're looking for a gamma squeeze, then you'd want to see elevated levels of options volume and elevated levels of sizzle volume. And then at the bottom, the put call ratio, which isn't really a part of the whole sizzle talk. Sizzle is something that Thinkorswim came up with. It's just a word for 5-day average. They made it up, which is why you probably won't find that word or sizzle tools on different brokers, because it's Thinkorswim's. They thought it up. But you can do this on your own, no matter what broker you're on. You can just look back at the 5-day average of something, right? And of something could be anything. 5-day average price, volume, option volume, whatever you want. So we're going to be looking for a significant change in market structure, market dynamics, and a resolution of this range that we've been in. The S&P is not the only thing that's been holding that range. The NASDAQ, the S&P, a lot of the big market cap names, they're all just balled up. We're looking for that significant structural change in the market, and we just don't have it yet. Even with all the violence and the volatility and the whipping around that we've had this week, we still don't have it yet. We're not any different than where we started the week. Because here's Monday's levels, and here's where we're at right now. And just because we started bearish this morning doesn't mean that's going to stick. Once we finally start to get an answer to all of this, then we can start putting on some trades to target the end of the year. For today, we want to play the levels that we've got, all the things that we talked about through the morning briefing today, focus on the pivot points, breaking everything down as we go. One of the things that you can break down is the distance of the range from yesterday. 39.50 would be half of the range. If we get a bump back to the upside, it should not climb higher than 40.43. That would be 50% of yesterday's move. We can come up and touch it. We can even wick through it, but we don't want to close above it if we're going to keep our bearish bias. $39.48 kind of lines us up from the gap back here that also needs to be filled, where we closed on Friday and opened on Sunday night. So I would focus on closing this gap this morning. As for that question about 1.8 times more volume today than we've had over the last 5 days, it's not really significant. One, because we got OPEX with all the additional volume coming. Two, the last 5 days has been hurry up and wait, hurry up and wait, hurry up and wait, because we got FOMC, right? So we've had a significant lack of volume, and now we've had FOMC, we've had CPI, we've had PPI, and now we're getting trading volume. So it would seem at first blush to be, oh, wow, that's a significantly more volume than we've had over the last 5 days. Yeah, but the last 5 days were really muted. So it's not hard to beat a muted market. And then with OPEX, we're going to see more volume than we normally would anyways. And that just muddies all of our tools. So what I got for you guys, be careful, be safe. Keep your eye on the clock. And once we get past 11:30, by noon, you should be good for your 0 days.